Hi, welcome back. So in 8.2 from your textbook, which is the income tax, this is another good application for this class of chapter 8. Okay, so let's go over the first slides, the objective for this section. So we have four objectives for this section. Determine the gross income, adjustable gross income, and taxable income. And we also learn how to calculate the federal income tax, calculate the Fica taxes, and also solve the problems involving working students and the taxes. So these are the four objectives that we are going to learn in this lecture. Okay, so first thing, what is income tax? The income tax is a percentage of your income collected by the government to fund its services and programs. So if you go to work, let's say that your salary is $50,000 a year, but in fact you are not getting $50,000 a year because you have to pay a portion of that to the taxes to the local and the federal government. Okay, so in this section we are going to learn on how to calculate your income tax and so on. Okay, the next slide. The first thing is, let's talk about the percent and the income tax. So how do I calculate my income tax? So there are a few steps that you should pay attention in this section. The first thing is, you have to determine your adjusted gross income. And what is the adjusted gross income? That is the amount, the difference between the gross income and the adjustments. So your gross income is all the income for the whole year, and that includes the wages, the tips, or the earnings from investments and unemployment, the money that you receive when you are not working. So all the money that you receive in the whole year is your gross income. And then the adjustments, that includes the payments to the tax deferred savings plans. So make sure that we take the difference between the gross income and the adjustment to get you the adjusted gross income. So that is the first step, the step number one, to find your income tax. Next one, the next step is to determine your taxable income. Your taxable income is equal to the adjusted gross income that you got from the first step, minus the summation of the exemptions and deductions. Exemptions could be a fixed amount of money for yourself. In the year of 2005, it was $3,200, and the same amount for each dependent. So if you have one child, two children, 3, 4, and so on, then you just add the same amount for each dependent to your exemptions. And it's different for every year, so not that much different, but this is the data from the year of 2005, and this year will be a different numbers here. So those are the exemptions. Deductions. Now we choose the rate of a standard deduction or an itemized deduction, which includes the interest on the home mortgage, the state income taxes, property taxes, charity works, the money that you make the donations, and medical expenses exceeding 7.5% of your adjusted gross income. Okay, so make sure that we have two choices. and we pick the one that has the rate of a standard deduction of unitemized deductions. We'll talk more about that in the next slides, the next few slides. Alright, so how do I find the income tax? The income tax is equal to the tax computation minus the tax credits. Now the tax computation is the one that you use your taxable income and the tax rates for your filing status, if you are single, married, divorced, and so on, to determine this amount. And we will see that in the next slide. And the tax credits, this may include up to $1,000 per child, the cost of the child care so a parent can go to work, and adoption credits for qualified expenses, and so on. So your income equal to the tax computation subtract the tax credits. Now let's go over one example, and hopefully it will make a lot of sense after this example. So this example from the textbook, we are finding the gross income, adjusted gross income, and taxable income. Alright, so let's go over this problem. A single man earned the wages of $46,500, received $1,850 in interest from a saving account, and also received $15,000 in winnings on a television game show, and contributed $2,300 to a tax-deferred savings plan. He is entitled to a personal exemption of $3,800 and a standard deduction of $5,950. The interest on his home mortgage was $6,500. He paid $2,100 in property taxes and $1,855 in the state taxes, and he contributed $3,000 to charity. Okay, so those are his information about the monies go in and out for the whole year. Now, first question: determine the man's gross income. Gross income. Okay. So go back to the first slide. The first thing that we learned from this section, the gross income refers to this person's total income. So that includes all the wages, the interest from a saving account, and the game show winnings. So anything that he received, and any money that he got for the whole year will be the gross income. So this man, he got the wages for this month, $36,500. Right, it's right here. So that is the way. And then he received $1,850. Right, that is his interest from saving account, and then he win the game show right here. So those are the three things that his money came in. Okay, so three different money. Now we add them up all together, then we get $63,350. So that is the amount for the gross income, and that is the answer for part A. Okay, next question, part B. Determine the man's adjusted gross income. Okay, so these are the problems. So go back to the definition for the adjusted gross income. The adjusted gross income is the gross income minus, so this is the total amount of the money that he received, subtract the adjustment. So that was the formula that we talked about on the slide number Number 5, adjusted gross income equal gross income minus the adjustment. Okay. So the gross income minus the adjustment. The adjustment in this case, what is it? That is his contribution of 2,300 to a tax deferred savings plan. So he has 2,300 to a tax deferred savings plan. So we subtract that outside of his gross income. So this is his adjusted gross income. The next part, we are going to determine the main taxable income. Taxable income. So what is that? So go back to, again, slide number 3. Taxable income is equal to the adjusted gross income subtract the summation of exemptions plus the deductions. Alright, so we need to subtract the exemptions and deductions from the so we need to subtract exemption and deduction from the adjusted gross income to determine the man's taxable income. Now, this taxpayer is entitled to a personal exemption. He has his personal exemption of 3,800. Okay, and he also has a standard deductions. This is a standard deduction right here, 5,950. So this is his standard deduction. However, a deduction greater than 5,950 is obtained by all the itemized items, which is all the deduction that we count individually for each item. Now go back to the problem. The interest on his home mortgage was 6,500. One thing. And he paid 2,100 in the property taxes. 2 items. Okay? And then for the state taxes, another money that he paid here, and he contributes 3,000 for charity works. So those are the money that he paid out. So we have to add all of them together. 1, 2, 3, 4. And if this number here is bigger than the standard deduction, then we go with the bigger one. We don't take the standard deduction. If it's smaller than the standard deduction, then we take the standard deduction. If the number is bigger than the standard deduction, we take this number here. Alright. So now we take his adjusted gross income you saw earlier minus the exemption 3,800 and the deductions or the itemized deduction that we talked in the last slide right here, and then 3,000 is the exemptions. So we sum this number and this number together. We subtract them from the adjusted gross income to get me the taxable income, which is 43,795. Okay. All right. So after we get the taxable income, we need to find the tax rate. Okay. So percent and income tax. So this table below here, it shows you the tax rates, the standard deduction, and the exemptions for 4 different filings status categories. So we can have unmarried, divorced, or legally separated. Married, and each partner files a separate tax return, and so on. Okay, so we have 4 different categories, and you have single, married filing separately, and so on here. Now, the tax rate we have a lot of different rates. 10%. So let's consider a case for the single. So if you work and you make the money, and your money is only from $0 up to $8,700, then we take 10% for that amount. Now after 8,701 up to 35,350, then we take the 15% to that amount, that interval only. And then from 35,351 to 85,650, then if you the extra amount from 35,000 to 85 here, then you take 25% of that amount only, and so on. And then the standard deduction is 5,950. Exemption per person is also 3,800. So this is a general table, and it could be different for different years. Okay. So now let's move on to his to calculate his tax rate. All right. So calculate the income tax owned by a single woman with no dependents. So this is another example. So we finished the example of the man. Now we move on to another example. So in this example, we compute the federal income tax. So calculate the income tax owned by a single woman with no dependents, whose the gross income, adjustments, deductions, and the credits are all given here. And use the marginal tax rates from the table that I show you right here. Alright, so we have a single woman with no dependents. Her gross income, her adjustments, her tax rate, and so on, and also her deductions. This is the itemized deductions. Okay. Alright, so step number 1. We need to determine the adjusted gross income. Adjusted gross income is equal to the gross income minus the adjustment. And we know that her gross income is 62,000. Subtract the adjustment. Adjustment is also given here, 4,000. So make a subtraction, you get 58,000. And that is her adjusted gross income. Now, after we get the adjusted gross income, we need to find the taxable income. Taxable income again is equal to the adjusted gross income minus the summation of exemptions and deductions. We also was given her exemptions. Her exemptions was 3,800, and that's 3,800, and that came from the table here, the exemption per person, and it's happened that we are all the same. They are all the same. Okay, so 3,800. Now this is a single woman, right? So we go with the first column for single. Okay, so that her exemptions 3,800. All right. So we got the exemption. What about the deductions? We need to figure out what is the deduction. Now, we need to go back to her problems. Itemized deductions. Okay, so she has 7,500 for the mortgage interest, property tax, her charity, and medical expenses not covered by the insurance. Okay, so we have 1, 2, 3, 4 different things. Now we list them here: the mortgage interest, the property taxes, her charity, and medical stuff. Now, another thing to to remember, for medical expenses, you can only deduct the amount if the amount of the medical expenses is bigger than or equal to 7.5% of your adjusted gross income. Okay, so her adjusted gross income is 58,000, right? So 58,000 is her adjusted gross income right here, 58,000. Now 7.5% is equal to 0.075 in decimals. So we take 7.5% of 58,000. So I multiply to that, and it gives me 4,350. So 7.5% of her adjusted gross income is 4,350. Now, if her medical expenses is bigger than this value, then we take that number. But because 1,500 for her medical expenses is less than this number, it's less than 7.5% of her adjusted gross income, therefore we do not count it. So that is the very important thing that you should pay attention to. Okay, so now we add the three of them, 1, 1, 2, 3. So we get total of 12,100. So pay attention to the medical expenses. So 12,100 for deductions in the formula for the taxable income. So this 12,100 go to deduction here. The reason that we don't take the standard deduction because it's only 5,950. This is little, right? This is small comparing her to her itemized deduction. So we take the higher value. Okay, so after that, we plug the values here, and we got her taxable income. Taxable income, okay? So after we find her taxable income, we determine her income tax. Income tax is equal to tax computation minus the tax credits. Okay, so income tax equal tax computation minus the tax credits. The tax credit we was given in her problem 500. Okay, so it's given from the problem. So now all you have to do is you find the tax computation. Okay, now because the woman here, her taxable income is 42,100. This is her taxable income, and this amount 42,100. It is between 35 and 85. 42,000 is between these two numbers. So her tax rate is 25%. So she falls in the tax bracket of 25% from the table here. All right, let's move on to see what's the next step. Okay, so we still need the table to do this problem. All right, so we know that she's fall in this bracket 25% because her taxable income was 42,100. This is her taxable income. So this is taxable income. So after we get the taxable income, then we take this number, we compare So 42,100 is in between these two numbers, and therefore she falls into the 25% bracket. Okay, now the 10%. So remember, we have to go from the top to the bottom. So 10% is applied to all the money up to 8,700. So 10% on her first 8,700 of her taxable income. And then next, 15% is from 8,701 to 35,350. And that is her 15%. And then 25% is the rest after 35,350. So she has a total of 3 different tax rates to apply to her income. Okay, so let's try to do that in here. All right. So let's do it here. Actually, let me pull up the table. Okay, so let's try this problem on another piece of paper. All right. Okay, so we have her taxable income. So let's think about this way. Let me write 42,100. This is her taxable income. Okay. All right. So now let's try to see how do I find her tax computation. Okay. So we know that we stack from 0. We go all the way. We go all the way down to her 42,100. So this is her salary. Okay, her taxable income. All right. So between 0 and 8,700. So 8,700. We apply 10% to that bracket. Okay, and now after that, until 35,350, we take 15%, and then the rest, she stop here. 25% is the rest. So now what I can do is I take for this interval 10%. So that means 0.110. You move 2 places to the left to convert it back to decimal. So 10% is 0.010. Of 8,700. Okay, because that is the first amount of the money. So that is the first one. For the second one, we take, so keep moving on. For the second one, we take the difference between these two numbers. So 35,350, we subtract 8,700. Where I take the subtraction to get the one in the middle. So this amount we multiply to 15% because that is the rate, which is 0.15. 50% if you move to the left 2 places, 0.15. Okay, multiply. And then lastly, we take 42,100. We subtract the ending here, 35,350, and the rate for this interval is 25% or 0.25. We multiply with that. All right, so now let's see all the calculation here. So this should be A70. Okay, if you do subtraction and multiply 0.15 correctly, you should get 3997.50. And then lastly, do the subtraction, multiply 0.25, you should end up with 1687.50. And because we have to sum up them, right? This is the summation, because you want to get her total tax computation. You add all of them together, you get 6555.00. So that is her tax computation, which is right here. Income tax equal tax computation subtract tax credits. Tax credit is 500 given to the problem. Subtract that. So the income tax owed by this woman is $6,055. So that's the long problems. So go back to the problem of the woman. Okay. So her gross incomes was 62,000. At the end, after everything, she need to pay the tax $6,055. So that's a lot of tax that we have to pay back. If you make more money, then you have to pay more. Okay, so that is the second example. Now let's move on to the next example. The next objective. All right. Okay, so the next objective, we are talking about the Social Security and Medicare. Or we have a special abbreviation for that, Fica. Now, in addition to the income tax, we are required to pay the federal government, the Fica, or the Federal Insurance Contribution Act taxes that are used for the Social Security and Medicare benefits. Social Security provides the payments to eligible or the people that are retired, or for the people that have health problems, eligible dependents of deceased persons and disabled citizens. Medicare provides the healthcare coverage mostly to all Americans of 65 years of age and older. Okay, so for the figure, we also have three different columns for three different categories. So depending on which one that you fall into, we will take the rates and we calculate that with the corresponding money that you have. Alright, let's go over one example. Computing the Fica tax. If you are not self-employed and you earn $150,000 a year, so what are your Fica taxes? Alright, so go back to the problem. go back to the column. You are not self-employed. So which one is your column? This is self-employed. This is matching rates paid by the employer. So you are not self-employed. So that means you belong to the first column. So the first column, we have two different rates. On your first 1,000, 100,000, 10,000, 110,000 of your income, you pay 5.65% of the taxes for the rate. And then after this amount, 110,000, then you pay 1.45% of the income in excess of 110,000. So this is similar to the problem that you did earlier. Now let's do this here. So this person make 150K. All right. Now let's draw the line here. So it's go from 0 so we go from 0 up to 150. Okay, and we know that according to the table, right, belong to this table, between 0 and 110,000 we have 5.65, and then after that it's 1.45. So it's pretty simple. Again, this difference here is 110, right? We multiply 5.65 in decimal 0.0565. You move two places to the left. Okay, and then here again you have to take the subtraction. 150K minus 110K to get the differences between the two numbers, and then we multiply to 0.0145. Move two places to the left to get you the rate of that. Okay, now if you multiply that correctly, you should get 6215, and then you should get 580, and the total, you sum them together and you have to pay 6795. So this is the amount that you have to pay for the Fica taxes. Okay, Fica taxes, 6,795, just right here for your Fica tax. Okay, so that is another application. Alright, we have one last objective for this section, which is the examples for the taxes for working students. Alright, this is a good example for the students to know. You would like to have extra spending money, so you decide to work part-time at the local gym. The job pays you $15 per hour, and you work 20 hours per week. Your employer withholds 10% of your gross pay for federal taxes, 7.65% for Fica taxes, and 3% for state taxes. First question, what is your weekly gross pay? Alright, so let's do that step by step. The weekly gross pay is the money that you receive before subtracting all the taxes. So now we know that you work 20 hours per week, and the rate each hour you are paid with $15. So take 20 hours times $15 per hour. So each week your gross pay should be $300. Alright. Next question. How much is withheld per week for federal taxes? From the problem, for your federal taxes, your employer withholds 10%. 10% is 0.110. You move 2 places to the left to make a decimal. So you take 10% of your gross pay. You multiply that to your gross pay. So you have to pay $30 for federal taxes. And how much is withheld per week for Fica taxes? Fica is 7.65%, and that is 0.0765 in decimals. So you multiply that to your gross income to get this number, and this is your Fica taxes. So take the amount of the rate multiply to the total income, gross income. This is a typo, should be 300. And then next question, how much is withheld per week for state taxes? You pay 3% for state taxes. 3% is what? Move 2 places to the left, 0.03. So multiply that to the gross income, again still 300. So you have to pay $9 for the state taxes. So the question is, what is your weekly net pay? So you got 300 for the gross pay, but after you pay the state, the Fica, you pay the federal taxes $30, Fica 22.95 together with the state taxes. 3 of them, you add them up all together, do the subtraction, you only get okay, this is again a typo. You got 300, subtract the sum of these three, 61.95. So at the end you should get 238.05. Okay, so even if you make 300 for gross pay, but after you pay your federal taxes, Fica taxes, the state taxes, you only get back $238.05. And then the last question, they ask you, what percentage of your gross pay is withheld for taxes? They ask you what is the proportion of that. Okay, so this is all the taxes that you pay are here. Together, they are $61 per 0.95. So we take that ratio comparing to the gross pay. We take that divided by the gross pay, and you move 2 places to the right to get it back to the percentage, because they ask you for the percentage, not decimal. So 20.65% or 20.7%, almost 20.21%, or 20 to be precise, 20.7% of your gross pay is spent for the taxes. So we take the ratio out of the gross pay. Okay, so that is the end of the section 8.2, the income tax. Okay, so let's move on to another section, another application for this chapter 8.3. It is simple interest. So we have only 2 objectives for this section: calculate the simple interest and use the future value formula. Alright, so let's talk about the simple interest. Now, the interest is the amount of the dollar or the money that we get paid for lending the money or pay when we borrow the money, maybe from the bank to buy the houses, to buy the cars, and so on. The amount of the money that we deposit or we borrow from the beginning is called the principal amount of money, or the principal. The amount of the interest depends on the principal and the interest rate, which is given as a percent and varies from bank to bank. So maybe this bank gives you a high interest rate, but the other bank can give you a lower rate. And the length of the time for which the money is deposited. Simple interest is a formula, is a way to find the amount of money for that principal or the deposit money, and it only involves the interest calculated only on the principal, so that the simple interest is only focusing on only the principal amount of money. So when I say that it's focused on only the principal, that means it does not count again the interest rate or the interest amount of money after a certain amount of time, like 1 month, 2 months, half a year, and so on. It just only counts based on the principal one time in the beginning when you borrow the money or when you lend the money only. So that's why it's simple. So we call that the simple interest. So to find the simple interest, we have a simple formula. We take the principal, which is the amount of money that we lend to someone in the beginning, or when we borrow the money from the bank in the beginning. We multiply that amount to the rate, the interest rate, and we multiply to the time. So the principal, the interest is normally we use the letter I equal the principal. The principal has the letter P. Rate is the small r and time is t. So the rate r is expressed as a decimal when calculating the simple interest, and so on. Alright, let's try one example. Calculating the simple interest for a year. So now you deposit 2,000 in a savings account at Hometown Bank, which has a rate of 6% a year. So you make a deposit 2,000 in that saving account at the Hometown Bank, and this bank has a rate of 6% a year. Find the interest at the end of the first year. Alright, so we find the interest at the end of the first year by using the simple interest formula, I equal PRT. P is the amount that you make the deposit in the beginning, which is 2,000. The rate, in this case, the interest rate is 6%. Again, 6% equal to 0.06. That is the in decimal. And then we multiply to T. T is the timing. The timing has to be in year. We want the time to be the end of the first year, or just 1 year, or just one. So we multiply all three of them together, you get 120. So after 1 year, the interest that you earn is 120. So you put 2,000 in at the end of the first year. Your bank has $2,120. So your money rose with the additional $120 a year. Okay, another good example. Calculating simple interest for more than a year. Alright, that is also the case. A student took out a simple interest loan for 1,800. So this is the simple interest. We know that we have to apply the simple interest formula for 1,800 for 2 years at the rate of 8% to buy a used car. Now find the interest on the loan. So you are looking for the interest amount of money that the student has to pay if he or she took out 1,800 for 2 years with the rate of So again, to find the interest of the loan, we use a simple interest formula, I equal PRT. The amount of the money that we borrow in the beginning is your P, your principal, 1,800. The rate R, 0.08 in decimal of 8%. The timing T, 2 years. It's right here. Multiply them together, 288. So the interest on the loan is 288. So at the end of 2 years, the student has to pay 1,800 for what he or she borrowed in the beginning together with the interest money. So actually you have to pay $2,088, not just the one that you borrow 1,800 only, because you have to pay the interest rate, the interest money as well. So that's how you find the interest money. All right, another objective, future value, the principal plus the interest. Now we have another notation, the future value A. We call A, the big letter A, to be a future value. The future value of P dollars at the simple interest rate R as a decimal for T years is given by A equal P multiply 1 plus RT. So P is also known as the present value. So A equal P multiply 1 plus RT. Actually, let's make it this way. I use a different notation from your textbook. So I said that future value equal present value 1 plus RT, just to make it easy to memorize the notation. Future, FV stands for future value. PV stands for present value. 1 plus RT, R is the rate. Simple, okay? Alright, so let's try more example about the future value. Alright, so a loan of $1,060 has been made at 6.5% for 3 months. Find the loan's future value. So in this problem, we are asked to find the future value. So remember that, how do I find future value? Future value equal present value 1 plus RT. So you are looking to find FV, future value. PV, present value. What is that? The present value is the value that you borrow now, or you have a loan now, which is $1,060. So this is your present value. 6.5% is the rate. In decimal, 0.065. 3 months. This is 3 months, right? 3 months. However, I told you earlier, the timing T has to be in years, not in months. So you have 3 months. You need to convert the 3 months to the years for the unit. So we can do that by dividing by 12. And why? Okay, let's do it step by step. 3 months. We know that there are 12 months in a year. This is conversion factor. So the month cancel, you get back the year. So 3 divided by 12 to get you the years. So if you are given months, divided by 12 to get back you the year. Okay, so that is 1/4 of a year, or 0.25. Now you have everything, right? Your A is actually, this is FV, right? A is just FV. FV, FV, FV. P is your present value. Okay, we got that, and 1 plus RT, and then that you get the amount of the future value, nearest cents, so 2 decimal places. So that's your future value. Okay, more example. Determine the simple interest rate. So now, you borrow a loan. You borrow 2,500 from a friend, and you promise to the friends that you pay them back $2,655 in 6 months. So they ask you what is the simple interest rate that you pay for this phrase. Okay, so you borrow something that is your present value, because that is the amount you get now. You borrow now. You pay back in 6 months, so this is the future value. So now they are looking for what is simple interest. They ask you for the value of R, right? And the timings, 6 months. Timing in 6 months. Again, this is in months, so you have to divide by 12 to get back to the years, or 1/2, or 0.5. All right, so let's do this problem together here. Okay, so remember there is a formula: future value equal present value 1 plus RT. You are looking to solve for R. Okay, so I go ahead and divide PV on both sides. I get FV PV equal 1 plus RT. I'm solving for R, so I need to subtract 1 on both sides. Cancel out. I get FV divide PV minus R minus 1 here equal RT. Now I'm looking for the rate. I'm looking for what is my R. Okay, so I go ahead and I divide by T on both sides. Okay, so the 2T they cancel out. So I have my R equal this value, FV over PV minus 1 divided by T. Now we got everything earlier, right? We got FV, which is right here, PV, which is right here, minus 1 divided by T. T is right here, 0.5. Okay, let me take a moment to do that on my calculator. 2655 divided by 2500 minus 1 divided by 0.5, that is 0.124. 0.124. And this is in decimal. Now you want the rate in percentage. You have to move 2 places to the right, or 12.4%. So the interest rate that you are paying your friends is 12.4%. Or you will pay a simple interest rate of 12.4%. Okay, so that is the end of the lecture for this section 8.3, and thanks for watching.